Major economic shocks are being felt around the world right now, from central banks to New Zealand households. So it is a good time to talk to Harry Smith, Portfolio Manager from Fisher Funds. Thanks very much for joining us, Harry. How are investors feeling right now?
Well, there's a huge amount going on right now, so it's not really surprising that investors have a mix of emotions. I think you can sort of bucket that into three different areas. One is you've got the very concerned investor. They might be making changes, going from shares to cash, or if it's KiwiSaver, going from aggressive to conservative. Then you have sort of a mildly concerned investor out there. They're just cautious, keeping a watch, looking at the news, that sort of thing. And then you have just those ones that are staying calm, and that's just steady as she goes.
So quite the range, almost the entire range really, isn't it? So why do people react so differently?
I think like our brains are hardwired this way, right? So I think we overweight risk and we underweight opportunity. Probably comes out of a survival mechanism. And there is actually economic theory behind this. It was come up by a couple of economists in the late 1970s that then won the Nobel Prize in Economics in the early 2000s. And it's called loss aversion. And essentially what it is that when we have a loss or a potential loss, we weight that twice as much as the equivalent gain. So if you bring that back to what's going on in the Middle East at the moment, it's really not surprising that investors are feeling a mix of emotions.
That's interesting psychology. In the last few weeks, Harry, you've been at pains to tell us that the markets are behaving as you'd expect. Are they still?
Look, I think I came on about a month ago, and it was at the start of the conflict, and I sort of just went through that. You know, since 1990 or the Gulf War, we've seen around 7 conflicts. And on average, what happens is the market falls 3 to 5% in the first couple of weeks and then recovers. And so this has been really an example of history rhyming, because that's essentially what has happened. The market did dip a bit further, but it has now recovered. And I think the US is going to make all-time highs again. So what's really interesting, though, in the context of this conversation is, you know, you think about how much attention that the first couple of weeks got and the sell-off in the market versus how much attention the rally back or the opportunity is getting. So, you know, it's a very good risk getting lots of attention, opportunity maybe not as much.
That's it, and it speaks to that same psychology you're talking about. Is it odd, though, that the market is nearly at an all-time high when this truce is still so fragile?
That's a great question. Look, geopolitics is still front and centre, and it has not finished as well, I should point that out. But I think when you think about the share market, it's important to remember earnings are what drives the share market. If you think about earnings, you know, geopolitics is one factor, but so is company-specific information. We've just started earnings season in the US, so we have the big banks like JP Morgan updating investors at the moment on their financial performance. So that's a driver of the share market. You have macroeconomic data coming out. Employment came out in the US really strong at the start of this month, supportive for earnings, supportive for the share market. And then you've still got massive themes like AI, for example, where a huge amount of investment is going into that. And that's, again, supportive for earnings and the share market. So geopolitics is one thing. I guess the other just point I'd make is that there is always a risk that the market is worried about, but history shows that the market is very good at climbing a wall of worry.
It's so important for us to remember these things at the moment as well, when everyone's feeling a bit anxious. I think we would be remiss if we let you go without asking what investors should do.
I guess my main message that I like today is really, you know, is asking investors to view their investments through the lens of their time horizon. So if that's KiwiSaver, that's typically long-term. So long-term means like, you know, 7, 10, 30 years if you're a 30-year-old, you know. So not paying too much attention to what's going on at the moment, which can be transitory in nature, and really just focusing on that longer dated, what the opportunity can be, not so much the risk.
Yeah, that's
and,
it.
and of course, I'd always say, don't check your balance.
Yeah, and that's exactly what I'm doing. I was about to say, I'm just burying my head in the sand. I'm not going to. I'm not looking at my KiwiSaver. I'm not opening my sharesies. I'm not doing any of it. Harry Smith, Portfolio Manager at Fisher Funds, thank you so much for your time this morning.
Thank you.
Of course, my ears were pricking up when you were saying 30-year-olds in that sort of bracket, right? It's just
Yes, same.
it's definitely us. If I can, an update on the search for a New Zealand monk missing on a small Scottish island next. We are crossing to London for the latest.